Good afternoon, Southern California. Let's do some business. We are doing it live right here, doing more at 4 weekday afternoons. We get right down to business with the news-driven hour right after Ben Shapiro, who was talking markets just a moment ago. And we all do this just before the 790 KBC News Blitz with Randy Wang at 5, Yabba Dabba Do Time. Mottek On Money, live on the air here, 790 KBC. Streaming live online worldwide at kbc.com and your on-demand Mottek On Money podcast, kbc.com, Apple iTunes, and all your favorite podcast platforms. TGIF, rough day for the stock market. It closed out the week and a rough start to the month of August. Stocks closing sharply lower today with the tech-heavy NASDAQ falling into correction territory. That is 10% or more below its recent high. Investors impacted by the softer-than-expected jobs report. The so-called Big Enchilada monthly economic reports came out an hour ahead of the opening bell this morning, and it came out weaker than expected. The Dow coming in for a closing loss of 611 points, settling at 39,737. The S&P 500 gave back 100 points to finish at 5,346, and the NASDAQ slid about 418 points at 16,776. All three of the major averages did rack up losses for the week. The S&P 500 down 2.1% for its worst week since April. The Dow down 2.1%, while the NASDAQ took the biggest hit, down 3.4%. The NASDAQ slide left it in correction territory. We'll talk more about that in just a moment. The magnificent one, NVIDIA, holding up pretty well in all of this, although it's come well off its recent high, down $1.94 today to 107.27. NVIDIA now reportedly being investigated by the Department of Justice over an acquisition as well as its practices on the sale of its microchips used to power AI applications. Political reporting, the Department of Justice was examining its acquisition of Israeli startup Run AI. Run AI has technology that allows for virtualization of graphics processing units. If you think you had a bad day, get a load of this. Jeff Bezos has a lighter wallet today, about $15 billion right out of his pocket. The sell-off in Amazon today, he gets the blame for that. Amazon shares moving sharply lower, translating to a $15.2 billion paper hit to Bezos' Amazon position. Amazon stock, by the way, slid more than $16 at $167 and change, down 9% on the day. The Russell 2K Small Cap Index, which has been putting in a stellar performance recently, down sharply today as well. In fact, showing its worst week performance since March of last year. Aggressive rally in government-handed long-term yields, their biggest weekly drop since the onset of the COVID pandemic in March of 2020. The bond yield moved sharply lower. 3.79% is the yield in the 10-year note. Had to hesitate there for just a moment. 3.79%. And that saw its biggest weekly drop since the period that ended on March 6, 2020, back during the pandemic days, just before the whole economy was shut down. Shares of major banks also took a hit today, with Citigroup tumbling more than 7%. Goldman Sachs, the big dog on Wall Street, down about 6%. And other big banks, Wells Fargo, down about 7%. Morgan Stanley, about 6.5% lower. B of A shares down about 5.5%. And J.P. Morgan Chase, the biggest one, down 5%. Well, the job picture very much in focus now. Recession fears, a growth scare, and Fed policy all being discussed after this disappointing jobs report today. Wall Street's fear gauge, the VIX index, the so-called volatility index, also moved big today on the upside, up about 26%, exploding higher, adding to gains from the previous session as that disappointing reading on the job front flashed a sign that the economy might be headed for recession. Gold, meanwhile, turned higher, kissing an all-time high, well above $2,500 an ounce. Oil pulling back on concerns about the global economy despite big nervousness in the Middle East. Shares of Chevron, meanwhile, dropping to a 5-month low after the oil and gas giant reported second quarter revenue that beat expectations. And the other big news is that Chevron is moving its headquarters out of California to Houston. Chevron has been headquartered in San Ramon here in California, Northern California. Oil futures ending lower today, contributing to a fourth straight weekly drop as concerns about the demand outlook in both China as well as the U.S. overshadowed the fears of a wider Middle East conflict that could threaten crude oil flows from the region. I'll discuss the latest news with the oil industry analyst extraordinaire John Kilduff at Again Capital and CNBC contributor. John Kilduff will be joining me live later this hour, also on the big Chevron news. Wall Street betting now that the Fed will cut the key interest rate by 0.5 percentage point in September. After that jobs report came out, the economy produced a paltry 114,000 new jobs in the month of July, and the nation's unemployment rate ticked higher to a nearly 3-year high of 4.3%. Now, I'll talk about that big jobs report and the latest on the job front here in Southern California with prominent Los Angeles economist Dr. Robert Kleinhens, principal at Kleinhens Economics, former top economist at the LAEDC, and former deputy chief economist of the California Association of Realtors. New realtor commission policies, by the way, are set to come into effect later this month. How will those policies impact home buyers and sellers? Well, all of that is a result of a settlement reached a few months ago, which got rid of the standard 6% commissions on home purchases. We'll talk about that. We'll talk about it with Dr. Robert Kleinhens live later this hour. But first, on your money, the markets, the economy, jobs, recession talk, and the whole works now. Joining us live now, the one and only Jonathan Hoenig, Fox News contributor, portfolio manager at Capitalist Pig Hedge Fund, and author of the book Price is Primary, How to Profit with Any Asset in Any Market at Any Time. Jonathan Hoenig, thank you very much for coming to line on this big day here today.
Yeah, Frank, I mean, pretty dramatic day. The big tech stocks, the Magnificent Seven started topping out almost a month ago. And, July was, in fact, one of the weakest months in decades. And we really saw that come to now even a culmination today. Today was the day they took all the stocks. I mean, the small cap, large cap, but it really was, as you said, some of those tech darlings taking on the chin. It's pretty stunning when you see a stock like NVIDIA, Frank, down 25% in just the last couple of weeks. Now, it's still up, of course, 50-60% year to date, but you've seen tremendous wealth destruction in terms of tech stocks. And now, in fact, some of the economic news, which had been positive, and particularly employment, is starting to turn south as well. So the mood on Wall Street has certainly turned from, I think, optimism to pessimism and straight out fear after this week.
On the air live with Jonathan Hoenig, and I have to say you nailed it, Jonathan. You told our audience here weeks ago not to buy the dips in falling tech, and said there was a changing the guard away from tech. So looks like you got a pretty good crystal ball here. And Intel especially hit hard this week on also the news that they're cutting 15% of its staff. Of course, Intel in focus, plunging, 26% today. This is a tech bellwether, and looks like it's having its worst one-day performance since the 1970s, which is hard to believe. And Intel, of course, one of the great early on tech darlings. What about Intel here and some of these other tech bellwethers?
Well, Frank, I think that we always talk about the importance of a truly diversified portfolio, and maybe focus on the good for a moment. This week we saw shares of Philip Morris, for example, at a new 52-week high. Coca-Cola was screaming high almost the entire week. So you really are seeing something that I know you've covered, this changing of the guard, if you will, and value is in, and Intel is anything but a value these days. What's interesting about Intel is that it was the must-own stock of the 1990s. It was almost like the NVIDIA of that era. But, Frank, it traded $70 a share in 2000, and it's never traded as high since then. So something to be aware for some of today's AI darlings, that sometimes when they correct, they never come back. So something to be concerned of, I think, for the long term.
All right. And NVIDIA, of course, you mentioned it, down about $2 today to 107 and change. Intel was down nearly $8 at 21 and change. What about, Apple, which had that big earnings news yesterday, ended slightly higher, it looks like, up $1.50 here at $219.86. What about Apple in all this?
Well, you have to, I think, Frank, of course, look at your own situation. Look at your own portfolio, but don't be tempted, in my opinion, by that so-called sunk cost fallacy. It's very tempting when we say, well, if I liked it at 50, I'll love it at 40. If I love it at 40, I'll love it at 30. And, we never know if a dip or correction, as you said, the NASDAQ's now in a correction, is just a correction or the beginning of a real longer-term move. So, if I'm putting money to work now, it's not in some of these weakening stocks. And it's in areas that are actually working, like good old AT&T. I mean, how boring is AT&T, right? This is the true widows and orphans stock, but Telecom has been breaking out, for example. ORAN is another one I own. It's a European telecom. So I think now's the time, Frank, to look off the radar screen and don't buy the dips. People who bought the dips in Intel and Cisco in 2000 didn't make their money back ever. The stocks never recovered from where they were.
On the air live with Jonathan Honig. Certainly, this was a bombshell here, this jobs report, and we'll get into the details of it. But this jobs report today suddenly changed a lot of outlooks and predictions here. Also, what the Fed might do. Some are already talking about the Fed should have lowered rates this week. They didn't, and signaled perhaps we'll get a rate cut next month. Has the Fed missed the boat here? And what about all these new predictions that we're seeing today?
Well, Frank, for me, it's all about looking at price. And boy, the price of bonds, the yield on bonds is screaming higher in terms of price and screaming lower. I mean, that 5% that was a given for savings, for years now is suddenly going to seem a lot more likable and achievable. So, rates are coming down dramatically. What that's helping are some of the dividend-paying stocks like utilities. XLU is an ETF that tracks utility stocks. It's at a new 52-week high today. Or even real estate, interestingly, Frank. Lots of talks about difficulties in commercial real estate. Well, IYR, that's the ETF that tracks real estate stocks. It's at a new 52-week high. So, the lower rates are going to help some areas of the market that have been hurting, and particularly those steady dividend players, many of them at new 52-week highs today.
All right, and speaking of new highs, gold above 2,500. Certainly we're watching that very closely. Looks like gold is just below 2,500 now, but this at a time when we're told inflation is under control and things were looking all rainbows and ice cream cones here. But gold making a big move on the upside. So what about gold and silver for that matter here?
I don't think the move actually, Frank, has really begun. And people look at an asset like gold at an all-time high, and it's natural. We think, oh, I can't buy it at its all-time high. I want to wait till it comes down a little bit. We're kind of programmed to want to bargain. But of course, what we think of as being the all-time high isn't the all-time high. More than likely, it's just an all-time high. And in a bull market trend, Frank, there's any number of reasons. I mean, today was gold was up because of weakness in the stock market. A couple months from now, it could be worries about inflation, any number of factors. So, all-time highs, it tends to be a bullish signal. So we own gold at capitalspig.com. You and I have talked about it for quite some time. And I do think as part of a portfolio, an asset like GLD makes great sense right now. Do your own due diligence, but I think gold absolutely works in today's market and works in most portfolios.
All right, and for that matter, what about silver and platinum, which you've mentioned in the past as well?
Well, you want to go with the strongest, and there's no question that gold has been the strongest. Silver has been right behind it. It's not up near its all-time high, which was reached I believe, a decade ago. Platinum's even weaker. But what you'll tend to see, Frank, is just as a rising tide lifted all boats when it came to big cap tech, once the precious metals really start going, and I think your point is right on. I mean, who are you going to believe? The price of gold at an all-time high or government bureaucrats telling you that inflation is coming down? So I don't think the story's over just yet, and gold, silver, and platinum make a great hedge. Again, not your only trade, but securities like GLD, SLV, and PPLT, I believe, make perfect sense in today's market.
All right, and certainly the cryptos are doing what they do, very, very volatile. At this time, 24 hours ago, Bitcoin was up more than 1,000. Now it's down more than 1,000 here at 61,000 heading into the weekend. Of course, they have the 24-hour crypto market, so people may have a sleepless night tonight as we head into the weekend. Ethereum down below 3,000 here now, I see, and Doge, which we quote at 11 cents here. What are your thoughts about what's happening in the crypto world this week?
Well, it kind of comes back to what we saw with the banks today, Frank. I mean, you saw some major banks take some enormous hits. I mean, when you see a stock like Citigroup or JP Morgan or Bank of America, Goldman Sachs down 6-8%, that's a pretty severe move. And what worried me is that you didn't see Bitcoin soar on a day like this. So I'm concerned about Bitcoin. I mean, it makes me think of that old adage, when the paddy wagon comes, they take the good girls with the bad. And my belief is when we get a huge stock market liquidation, a real sell-off, 1,000, 2,000 points on the Dow, I just don't see Bitcoin outperforming on a day like that. So, look, you can only bet on, you can't bet on everything. For some people, Bitcoin is like a religion, but one name I would consider actually is an ETF that goes short Bitcoin. If you want to bet against Bitcoin, BITI is one to consider. Again, you want to do your own due diligence, but if you want to go short Bitcoin, bet against it, BITI goes up when Bitcoin goes down.
On there live with Jonathan Honig, and of course, among the movers and shakers you talk to, and you see all the reports, and the dust is still settling. I'm sure there'll be a lot of new write-ups here over this weekend, but on this, all of a sudden, recession indicators flashing all of a sudden here, and let's see, the year-over-year job openings falling more than 10%, 23rd consecutive monthly decrease, by the way, the longest streak since the 2008 financial crisis, and mentioned some other things that we haven't seen since the economy was shut down in March of 2020, that aggressive rally in U.S. government treasuries. Long-term yields saw their biggest weekly decline since the onset of the pandemic. What about all this recession talk all of a sudden?
Well, I mean, one other indicator, and I think the market is the best forward-looking indicator we have. Another one, Frank, that's been on my list is the shares of UPS. That's United Parcel Service. It just in the last week, it was at a new 52-week low. It's down 20% year to date. It's a great example of a company that's, very dependent on a thriving economy, thriving market. And the fact that UPS has been such a laggard, to me, is probably the best forward-looking indicator we have. I'm not a Cassandra. I'd never bet against the country, but I think you got to be very cautious when putting money to work right now. You never know, as we said, if that 10% correction is the beginning of a 30% bear market.
All right, and oil also under pressure despite the rising tensions in the Middle East, and of course a nervous weekend there. We'll be talking to John Kilduff about all that later this hour. But what about oil and all this? Down today to 74 and change.
Yeah, in fact, one of the stocks at the 52-week low was ConocoPhillips, COP, which I was surprised to see. I mean, they came for even the oil, big stocks, small stocks, kind of across the board today. So I think you got to be cautious, Frank. If the economy really slows, I guess one of the benefits is that our energy costs could go down pretty dramatically. In fact, the cost of natural gas has been at a new 52-week low for days now. So we're seeing energy costs come down quite dramatically. And look, the good thing is we know that the country is producing quite a bit of energy. So, if you own oil stocks, if you own energy stocks, if you own them at a gain, I think you try to hold on for the long term. But short term, as I said, borrowing that line from Jesse Livermore, he said, there's a time to go long, a time to go short, and a time to go fishing. I don't think now is a great time to be dipping your toe into the big oil patch until prices at least begin to stabilize.
All right. And along those lines, any other specific places where you are putting money now and or taking it off the table?
Yeah, sure. One that's pretty off the radar screen, Frank, is some of these European and international names. One of the market movers we saw today was as the price of gold was going up, the value of the dollar was going down pretty dramatically. So EWK, that's EWK, that's a fund, an ETF that tracks stocks of Belgium. An interesting mix of insurance and breweries and forestry companies. What I like more than anything, Frank, is that they are dirt cheap. Here's a stock market that trades lower than it did 14 years ago. So at a time when you're looking for value, I think that's a place to consider EWK as against trying to pick bottoms in stocks like NVIDIA, which are still falling knives.
All right. Well, terrific, Jonathan. Thank you very much for stepping up to the plate and handling this big down day today. We appreciate it. Up, down, whatever it is, I know you can handle it, and we always appreciate it. Jonathan Honig, Fox News contributor, Fox Business contributor, portfolio manager at Capitalist Pig Hedge Fund, and author of the book Price is Primary, How to Profit with Any Asset in Any Market at Any Time. Jonathan, wish you a great weekend, and thanks very much for coming to the line this afternoon.
My pleasure, Frank. Be well.
Thank you very much, and right out of the freeways now on this Friday afternoon on 790 KABC. Mottek On Money continues here on 790 KABC. Rough landing for the stock market today with the Dow Jones Industrial Average taking a tumble down 611 points at the closing bell, settling at 39,737. We see the S&P 500 down 100 points at 5,347, and the NASDAQ tumbling 418 at 16,667. 790 KBC welcomes Jim Brewer, Survival with Laughter Tour. The Canyon Agora Hills is the place, September 8th. Tickets are on sale now at AXS.com. Right now, caller 9 wins at 1-888-790-5222. You can get a pair of tickets to the show if you're caller 9. Call right now, 1-888-790-5222. Tickets furnished by The Canyon, where music meets the soul. We'll take a closer look at the jobs report, which rattled the financial markets today, coming up, and I'll talk about it with Dr. Robert Kleinhans, prominent Los Angeles-based economist. That and more straight ahead. Right now, the latest news for you here on 790 KBC. Mottek On Money continues here on 790 KBC. The latest jobs report sent shivers through Wall Street today and upended a lot of predictions, especially what the Fed's next move might be. Wall Street now betting that the Fed will cut a key interest rate by a half percentage point next month after the uglier-than-expected jobs report came out today, resurfacing talk of recession. The economy produced just 114,000 new jobs in July, and the nation's unemployment rate rose to a nearly three-year high of 4.3%. Let's bring in prominent Los Angeles economist Dr. Robert Kleinhans, principal at Kleinhans Economics, former top economist at the Los Angeles County Economic Development Corporation, former deputy chief economist at the California Association of Realtors. New realtor commission policies, by the way, are set to come in effect on August 17th, and let's talk about that as well. But first, Dr. Kleinhans, thank you very much for taking the call and give us your reaction to the jobs report we got today.
Well, thanks. It's always great to be here. Frank, thanks for the opportunity to talk today. I was not as discouraged by this labor market report as has been printed in the news. I mean, the job gains in monthly terms were slower, the second slowest monthly gain this year, but we still are seeing job gains. If we take a look at the year-to-year changes that have occurred in the national economy, they're pretty close to what we saw back during the Goldilocks period of the teens, just before the pandemic. We have more job openings still than we have unemployed. The inflation rate is falling, approaching the Fed's target rate. Wage growth is slightly higher than the rate of inflation. GDP growth is faster than one would expect with these higher rates. So it doesn't really sound to me like the economy is stalling out at this point in time, nor is likely to do so over the foreseeable future.
All right. The outlook the day before yesterday was that the Fed was achieving the so-called soft landing that they were trying to achieve by bringing inflation down without pulling the rug out from the whole economy and orchestrating this slowdown. Are we going to see a soft landing here with this revived recession talk? What do you think is ahead here at this point?
Well, so, right now we're on track to do a whole lot better than a soft landing in the sense that GDP growth for this year is probably going to exceed our potential growth rate of 2.2%, or we're going to be very close to it. So we're not going to be seeing a recession. So if we achieve that growth rate and we sit at about 4.4% unemployment, with the Fed finally being done with all this rate hikes and now maybe looking at rate cuts, I would consider that to be a soft landing, yes.
All right. The tech sector taking a hit in the financial markets today, as well as on the job front. We're seeing many jobs being lost in the Bay Area. For example, tech companies and Intel announcing a whopping 15% of its workforce will be going away in a restructuring there. What is the outlook, especially here in California, on the tech front?
Well, I think it's a difficult time. It has been ever since the quote end of the pandemic. The sector arguably probably had overhired during the pandemic, and then we've seen a series of cutbacks over the last couple of years. A lot of hopes have been pinned on growth in that sector with AI coming on the scene and making waves, but that obviously hasn't come to pass yet. So there's some consolidation taking place in that sector of the economy. I might also mention, related to that in the overall organizational scheme of the economy is in information is the motion picture and sound recording or entertainment sector, which has been losing jobs and had lost jobs. That actually registered a year-to-year gain in this last month here in LA. So we've got some good news coming up, even as we're hearing some of the bad news.
All right, so we are on the air live with Dr. Robert Kleinhans, a well-known economist here in Southern California. So at this point, how's if you can drill down what's happening here in the Los Angeles area, how are we doing compared to the rest of the states and the rest of the state and the rest of the country?
Yeah, so first off, with respect to the state's unemployment rate is the highest of all the states in the nation. So there's the bad news. The good news is that the differential between the state rate and the national rate is about the same as it is on average. California and LA County both are struggling in terms of their labor force. They just haven't yet gotten back to where it was before the pandemic. So that's a concern. On the other hand, when we look at wage and salary numbers, both California and LA County have achieved those pre-pandemic levels. It's just that it's taken longer than some of the other parts of Southern California, notably the Inland Empire, which returned to pre-pandemic levels well before LA County and Orange County. So it's a mixed picture. The real job gains that are happening right now, both in California and here in Southern California, are occurring in just a handful of sectors. They're happening in healthcare, they're happening in government, leisure and hospitality, and to some extent construction. We're seeing some other sectors of the economy that are still losing jobs. That includes manufacturing, finance, and insurance. So it is a mixed bag. Really, it's important to keep in mind that right now job gains are really concentrated in just a handful of sectors across the state and here in Southern California. And we already talked about the tech losses earlier.
On the air live with Dr. Robert Kleinhens, longtime economist here in Southern California. And if you put on you formerly served as the Deputy Chief Economist of the California Association of Realtors. If we can talk about real estate for just a moment, give us your thoughts about what's happening on the real estate front, as well as the new Realtor Commission policies, which are set to kick in later this month.
Yeah, so I would say that the housing market has kind of played out here in 2024, similar to what I was expecting all along, which is we started the year with very tight inventory conditions and high mortgage rates. So that means affordability would be difficult. But some people are able to afford homes, and those tight inventory numbers are keeping upward pressure on home prices. So in LA County, the median home price was about $890,000 in June. That was up 6.8% from a year earlier, but home sales were down 15 or 16%. That's pretty much the case across the board here in Southern California, that you've got steep declines in home sales, but you have continued increases in home prices. So affordability with these high home prices and high interest rates, affordability continues to erode. New home production continues to be below where it was a year ago. So there's really nothing in the picture right now that's taking pressure off the housing market. If we do get some relief in the form of lower policy rates from the Fed a little later on in this year, that is going to translate into lower mortgage rates, and that should help to lift home sales as we move out of the busy season and into the fall.
All right, and what about the new rules here following the settlement with the National Association of Realtors? They got rid of the standard 6% commission on home purchases. What impact do you think these upcoming changes will have on what's happening here in Southern California?
Yeah, and I think I ought to start off by saying that we traditionally hear about 6% commissions, which are typically split evenly or roughly evenly between the agent who represents the seller and the agent who represents the buyer. But in recent years, especially with the internet, all sorts of other innovations that have been taking place that have affected the housing market, the typical commission rate is probably lower than the one that we typically think of at 6%. I don't have an exact estimate. So how is this going to play out with this new law? The buyer and the seller, the buyer is going to have to seek an agent to represent them. Not unlike before, or the buyer could try to represent himself or herself, which is kind of a risky situation, especially here in California. But I would think that to the extent that the potential buyer engages an agent, they're going to have to come up with some sort of a tentative agreement with respect to the proceeds that are going to go to the buyer. But ultimately, I mean, I see that the the buyer's agent's going to have to talk to the seller agent. They're going to have to figure something out, because if the seller agent says, well, I'm going to have 5% commission as opposed to 6, they're going to have to figure out how that's going to split. So,
all right,
I think
we're going to have to stop there on that one, on that important point. We're going to have to probably do a whole show on that, because that's obviously a biggest change we've seen in years for real estate. And Robert, of course, you're a very highly sought-after speaker at conferences, and I see you have a big event coming up in the Inland Empire in a couple of weeks. Tell us about that briefly.
Oh, that's right. So thank you. We are having the Inland Empire commercial real estate event at the Riverside Convention Center. It's on Thursday, August the 15th at noon. It's the Commercial Real Estate Women of the Inland Empire and BOMA, the Building Owners Management Association, that are co-hosting this on the 15th. So check the web to see if you're interested in signing up. Thank you.
Thank you very much, Dr. Robert Kleinhans, principal at Kleinhans Economics. Always appreciate your assessment here live on Mottek On Money on 790 KBC. Mottek On Money continues here in 790 KBC. Another big company moving out of California. Chevron said they're packing up their headquarters out of San Ramon in Northern California and moving their headquarters to Houston. Chevron stock today moving lower today, down more than $4 at $148 and change. This as the price of oil also ended lower, contributing to a fourth straight weekly decline on concerns about the demand outlook here for the U.S. economy here in the U.S. as well as in China, overshadowing fears of a wider Middle Eastern war that could threaten crude oil flows from the region. The U.S., meanwhile, now boosting its forces in the Middle East in preparation for a possible Iranian attack against Israel and sending to the region more warships and fighter jets, according to a statement we got today from the Pentagon. Following all these developments very closely, joining us live now is oil industry analyst John Kilduff at Again Capital, also CNBC contributor and longtime contributor to this program. John, thank you very much for taking the call on all of this afternoon. Give us your assessment of the big news here, first of all.
The Chevron news, Frank. Well, they have been slowly easing out of California. I think this shouldn't be a big surprise. They sold their San Romeo campus back in 22. The dealings I've had with the company over the years, they've always had a significant Houston footprint. I guess our friend Elon Musk blazing the trail out of your state there. Look, I mean, if you're a fossil fuel company, California is certainly not the most hospitable of locales. As you know, California is part of a lawsuit against all the fossil fuel companies for their alleged contribution to global warming, climate change, whatever it's called now. And if they're taking away the welcome mat, there's obviously places to go. I noticed that Governor Abbott from Texas went on to Twitter and gave them a big welcome. So not a surprise, Frank. Won't change a thing. I think, though, it's a good time to just remind everyone about the importance, though, of this industry, of the Chevrons and the Exxons of the world. We saw how bad the economy gets hit when oil supplies get threatened or strangled, even to the slightest degree. The economy starts to tank. Consumers are hurting because as much as we all maybe want and aspire to an electric vehicle in world future, it's not here yet. And until we build that bridge to the future, we can't burn down the old one. But that's what some folks here want to do. And unfortunately, you're losing a tremendous corporate citizen in Chevron. It's a great company, does a lot of good in the community. They'll continue to do that. But it's a shame, really, if you ask me.
Well, it should be noted also that 100 years ago, California accounted for 25% of the world's oil production. So a lot of the wealth that was built here in California came from oil money. So now Chevron's out. Occidental Petroleum left some time ago also to Houston from its headquarters here in Los Angeles in Westwood. So government policy certainly impacting the oil companies and consumers certainly paying the price for it. Our gas price is higher than Hawaii, which is in the middle of the Pacific Ocean.
That's right, Frank. And like La Brea tar pits, for example, that's fossil fuel right there. You go to Kern County, you see the derricks, the oil derricks still going. And of course, there's offshore activity too in California. So yes, California led the way to a very important commodity that remains essential to the global economy and needs to be relatively cheap.
And, of course, with all those changes, Middle Eastern oil, we rely heavily, the whole world relies heavily on Middle Eastern oil, and that's the area that's the focus again this weekend. It's going to be a nervous weekend with the U.S. forces now moving in that direction, for bracing for a possible Iranian attack against Israel. And give us your assessment of what could happen this weekend.
Well, they're gearing up, Frank. And look, if people are wondering why it's taking them so long, Thursday they had the funeral procession and ceremony in Tehran for the killed Hamas leader, and today is Friday prayers. Today is their Sabbath, so I didn't expect anything to happen today. However, it's now we're all on watch here over the weekend, Saturday, Sunday now. It is very likely that we will see that Iranian response here before we come into the open on Monday morning. This one can't stand. I mean, you and I have talked about the various incidents in the Middle East over the years, the bombing of Saudi Arabia's main production facility in Abqaiq, other diplomatic affronts that were just let go, and the failure of Iran several months ago with that volley of over 100 missiles that all got shot down but one by the Israeli defense systems. I think you're going to see a very determined response here. And unfortunately, this is one time I usually, because I've been doing this a while, Frank, as you know, I advocate just being measured and not getting too excited about it. I have to say this time around, I am concerned, and we could see these oil prices skyrocketed before this employment report here this morning, which took the rug out from all the markets, as you saw. But it's a concern, Frank, and there really could be supplies at risk this time around.
John, we look forward to your reporting and commentary here, and we'll look forward to speaking with you again next week, and we'll be watching what happens this weekend very, very closely. That is oil analyst John Kilduff at Again Capital and CNBC contributor, longtime contributor on this program, which is Mottek On Money on 790 KBC. Stay tuned now for the 790 KBC News Blitz, and tune in again with more at 4. It's Mottek On Money on 790 KBC.
Are you tired of losing your fantasy football league year after year? Lindsey Rhodes, Emmy-winning sportscaster and football analyst, is your new secret weapon on the Believe Fantasy Football Show.
Watch the quarterbacks and his ADP. I think he has massive high-end upside.
Get expert analysis on player rankings.
Wide receiver 22 in fantasy, Cecil Shorts.
That kid can run, so I'm thinking he can have a breakout season this year.
And you can too by searching the Believe Fantasy Football Show. That's BLEAV wherever you listen.